Thank you, Aditya and Investec for hosting this call. A very warm welcome to everyone present, and thank you very much for joining us today to discuss the operating and financial performance of our company for the first quarter ended 30th June 2021. I hope all of you, your families and friends are doing well. At V-Guard, our thoughts are with those who are affected, and our key priority remains that of ensuring the health and well-being of our employees, their families, and all our workplaces. During Q1, we have delivered a fairly strong financial and operating performance while bearing the impact of the second wave of COVID-19. Q1 revenues were higher by 38.2% YOY to 560.7 crores. The months of April and May were significantly impacted as the second wave was more severe than had originally and generally been expected. Specifically for V-Guard, there is a high business contribution from southern and eastern markets of the country. These regions were more affected to a greater extent, and they were locked down for longer periods of time. Overall, South and non-South markets witnessed a YOY growth of 34.7% and 43% respectively. Non-South markets contributed to 43.2% of the total revenues in Q1 as compared to 41.7% in the same quarter last year. The faster expansion in non-South markets is in line with our objective and follows the significant investments committed in developing high-quality products, widespread distribution, and nationwide brand over the last few years. Even so, during the quarter, our growth has been broad-based across product categories and geographies. Electricals and consumer durables have expanded extremely well, while some categories such as electronics and air coolers had substantial impact on top line with the second wave of COVID-19 coinciding with the peak summer season. During the course of the first quarter, we saw progressive improvement in big business as the second wave abated and the conditions normalized to a great extent. As a result, we delivered a stronger top-line growth in the month of June. Subsequently, the second quarter has seen improved momentum as the country opens up and government vaccination drive covers a larger part of the population. Extended closures not only subdued consumer demand but also led to disruptions to supply from our manufacturing units, especially in Sikkim. Further, there has been significant commodity price inflation in the last few months. We have been able to offset a major part of the impact. Some residual pricing actions are being planned in the coming months as well. In addition, A&P spending has been increased to support the anticipated business growth. Overall, we expect the business to bounce back strongly in the coming quarter, which should drive revenue growth and margin expansion. Our gross margins expanded by 380 basis points YOY to 33% in Q1. EBITDA margins were at 7.7% as compared with a low of 2.2% in Q1FY21. We expect the further improvement during the rest of the year as sales volumes continue to expand. During Q1, advertisement and promotional spend increased to 2.5% of revenues in Q1FY22 as compared to just 0.8% in the last year's first quarter. PAT increased by over 6 times to 24.6 crores from a very small base. Net profit margin was at 4.4% as against 0.09% in Q1 FY21. Our net cash position decreased from 349 crores to 154 crores in Q1 due to conscious build-up of inventory as well as market closures during lockdown impacted collection. We expect inventory levels to normalize in the coming few months. Our debtor days remain well within normative levels and we continue to uphold discipline in credit control and collections. Going forward, we expect improved business conditions as the economy faces sharp recovery based on expectations. We remain confident that in the longer term, strengths associated with our brand, distribution and product range, as well as the resilience demonstrated by the organization in a tough operating environment, provides the platform for a broad-based growth opportunity. On that note, I would like to thank you once again for your participation and would like to hand over the floor to the moderator for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi, good afternoon, sir. So the first question is to understand a bit more on the demand side in terms of after 1Q, July onwards, how has been the demand momentum? You did mention of expectation of sharp recovery in the business sentiments. So how should one look at the broad-based demand outlook from the key markets and regions?
So July has been very encouraging. I mean, I'm not at liberty to disclose the numbers, but I can say that July has been very strong. It does look like that we should, make up for a good part of the lost sales in Q1 by H1.
And any reasons to worry from the recent surge in cases again in South, especially in Kerala?
Not really. I mean, Kerala has been improving month on month, Kerala, is having a surge in cases. I mean, or rather, the number of cases are not coming down like the other parts of the country. But Kerala also has performed well both in June and July. So nothing to worry on that front.
Sure. So the second question is on the margin side, specifically if you look at segment-wise margins, say for electrical, which seems pretty steady at 9.5% levels. So how should we look at some of the category level margins as in irrespective of how the copper prices are moving on an annualized basis? Are 9.5% margins in the electricals category now steady given the changes in the mix and the structure?
So there is one category which is wires and cables where the copper content is almost 70% of the total cost of the product. In other categories, copper is not a very, not the most dominant, raw material. In the case of wires, there is a price increase or decrease as and when the copper prices changes. The market is gotten used to the fact that branded companies are changing prices frequently both upward and downward. So with a lag, yes, if you look at a 12-month window or a 12-month number, it should largely remain stable.
Sure. And so lastly, what is the quantum of the residual price hike that we are planning now for during the second or the third quarter? And with respect to capex for new manufacturing facilities, what are the categories that we are targeting in-house manufacturing, especially in the new entity which is being planned? Thank you.
So Darshan, you want to take this?
Yeah, okay. So there are a little bit of pricing action still to be taken. I think at an overall company level, it may be like 1.5 to 2%. Like Nitin mentioned earlier, bulk of the pricing actions have already been taken, so a little bit is left. Coming to in-house manufacturing, there are a few categories that we are planning to bring in-house. Those are the ones which we are currently either importing or sourcing from OEM. So here we are talking about some part of the fans range. Then there is stabilizer and inverter manufacturing. We are also looking at perhaps kitchen coming in-house in course of time.
Okay, nothing on the kitchen appliances or the other portfolio here?
Yeah, no, I did mention kitchen, but that also should come back in the plan.
So, and what is the quantum of capex which we have outlined in the next 2 years, specifically under the new subsidiary which has been crafted?
It's about 70 to 80 crores a year.
Got it. Thanks, I'll get back in the queue with more questions. Thank you and all the best.
Yeah.
Thank you. The next question is from the line of Prachi Kodika from B Capital. Please go ahead.
Yes, good afternoon, sir. My first question is on a loss of production. So you said that in Sikkim as well as in the south, we lost a lot of sales because of lockdowns. Do we have a sense as to, what sort of, or an amount to what would be the loss on sales because of both these lockdowns as well as, plant closure?
So if you look at, think about sales, May is a month we typically do between 250 to 300 odd crores. And the month of May, our sales was something like 90 or 100 crores. So the May month alone, I think close to 150 to 200 crores of sales loss was there. That's the quantum of sales, and there is of course some sales loss that has happened in the month of June as well. So yeah, something about around 150 to 200, about 200 to 250 crores, 250 to 300 crores could be the quantum of sales loss, because typically, Q1 is a strong quarter for V-Guard, so we should have done, at least 250 to 300 crores more than what we have done. In the case of sales loss due to lack of production, like we mentioned in the opening remarks, we had substantially increased our inventory levels. So we were sitting with a huge amount of inventory in many categories, so we have effectively not lost any sales yet. But there is something like water heaters. We are not having sufficient inventory going forward. So if further disruptions happen, as of now the plants are open. If further disruptions happen, we could again face the sales loss. But so far, I wouldn't say we have got any sales loss due to lack of production happening.
Okay, got it. And you also mentioned that the stabilizer stabilizer segment has not done well in peak season itself. So do you think this demand is gone forever, or do you expect it to come back? How has July been in terms of demand for stabilizers?
So if you look at last year, also was a washout for us in Q1 in terms of summer products. But in the case of stabilizers, it did come back strongly. So, but we still did not grow in the category. So for a full year number, stabilizer sales in FY21 was lower than FY20. So if that is to be taken, and projected, we can expect a flat year for stabilizer even this year as well. That means for last 2 years, the category would have not grown. Some of the sales will come back, but some of them are lost for it.
Okay, got it. And lastly, again on the EBIT margins, again for the stabilizer category, the December and March quarter, we saw some pretty strong margins which were upwards of 20%. But in this quarter, we've seen a sharp fall down to almost 13% for stabilizers. So what is the reason for that, and how should we think of these margins going ahead for the rest of the year?
Okay, Sudarshan, you want to take it?
Yeah, okay.
Yeah. No, basically, right, I think we're talking about margins, right, gross margins. Gross margins are maintained. It is basically the gross profits and gross of revenue also. So, the revenue has something strong for the electronic category. Both stabilizer and inverter are strongly correlated with summer. And starting April, sales have started to dip down in these two categories, and May was a washout completely. So I think the gross margin is fine. I think the gross profit picture is impacted by revenue.
Okay. And how should we think of these margins for the rest of the year? What would be a sustainable level for the margins? Hello?
Sustainable levels, Sudarshan, you want to take this?
Okay, let me answer that. See, given a normal year, the business should be returning a 10 to 10.5% margin, which is about the underlying margins the business can deliver.
Okay.
Yeah, like Graham mentioned earlier, even in Q1, the gross margin has been in line with what it used to be. There is a volume effect, which is why the EBITDA is lower.
Got it. All right, that's it from my side. I'll get back in the queue. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 now. The next question is from the line of Achal from JM Financial. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity, sir. My first question is, with respect to imports. So how much of the total sales were from the imported products, and have you seen any material impact because of the ocean freight or the currency, etc.? And given our focus on the manufacturing part, how do we see the outsourcing from FY21 comparing to FY21? What kind of proportion we had, and in next 3 years, what kind of reduction can we expect?
So the first was on imports. See, V-Guard had almost 7 to 8% of its products imported, maybe 6-7 years back. Today, I think it's down to about 2% if I'm not mistaken. So the impact of imports today is very negligible, and even that 2% is primarily kitchen appliances which we are importing from China and Vietnam. That also we are looking at possibility of sourcing within the country. Ocean freight, yes, has impacted. So if you look at ocean freight alone could have accounted for increase in decrease in margins for these particular categories. But if you look at the company as a whole, imports is not a very large item, so the impact on the entire business may not be very large. Apart from this, we are also importing some metals like copper and certain other components. Certain compounds are imported which is used for vitreous enameling. We are also importing components for water heaters that are also imported. But I think all this has been factored in. So today when we are costing them with the latest ocean freight, which is almost 5 to 6 times the normal rate. So all these costs have already started to hit us in the last 6 months, and I don't think there is going to be a further surge in rates. And today the rates have in fact come down from the peak, but they're still much higher than what it was before.
Right. And in terms of the outsourcing, how much was that in FY21, and given our focus on in-house manufacturing for those products, what is the mix we are looking at, let's say 3 years down the line?
So definitely in the next 3-4 years, another 20% odd of outsourced products will move inside. That will be batteries, inverters, some amount of cable particle and wall fans all will be moving in. So yeah, roughly about 15 to 20% of So today we are at 40% of manufacturing. It probably will go to 60% in the next 3 years, 3 to 4 years.
And how much margin can we look at in terms of the gross and EBITDA margin with this in-house manufacturing incrementally?
See, it's going to be difficult to say, but all we can say is that every time when we insource the product, we are seeing margins expand, and we are seeing, despite higher depreciation, higher labor costs and all that, they are still margin accretive. I can't put a figure on this because it's a different case for different products. And when we start a manufacturing unit, obviously the first 18 months to 24 months it will be running in a loss, and only then after that the margins will be expand. So the impact of all this will take some more time to flow.
Right. And just one more question with respect to price increase. Can you help us understand, since September 20, as in when the commodities start moving up, how much is the cumulative price increase we have taken, excluding wires, because wires is more function of copper directly, but excluding wires, what would be the quantum of price increase we have taken till 30th June?
So listen, can we give a weighted average price increase figure?
Yeah. So in the past month, excluding wires, depending on the category, the range will be somewhere between 6 to 11%.
Okay.
Depending on the category, yeah.
Understood. And if I may ask, with respect to competitive intensity, have you kind of seen that particularly increasing in few categories and also in terms of our southern region?
So, I mean, there is nothing new in terms of competitive intensity. Whatever, it's been happening is continuing to happen. And what will happen is, due to competitive intensity, some of these companies may delay their price increases and all that by 1 or 2 months. That's the most that has happened. Other than that, there is no, particular renewed, competitive intensity. I mean, this market remains and will continue to remain hyper-competitive as it has been in the last 3-4 years.
Understood. Thank you. I'll come back in the queue for more questions, sir. Thank you.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity. If you could comment on the competitive intensity and your market share, specifically in categories such as fans, water heaters and wires.
Ram, you want to take this? Hello, Ram?
So please give us a moment.
Okay, since you are proper. Okay, anyway, so see the competitive, products like fans and water heaters are fairly hyper competitive. I mean, in water heaters, we are the incumbent brand, and there are a lot of new challenger brands that are trying to take share away from us. In the case of fans, it's vice versa. We are the ones who are taking share away from our competitors. In the case of fan, at least we have made good inroads. I mean, our new plant to make decorative anti-dust fans has come online in the beginning of last financial year, and it has significantly helped us to gain market share in that particular segment. That is the decorative segment from as a 2,000 to 4,000 rupee segment. And we continue to launch new products from the factory, and it is getting very good traction. In the case of water heaters, in fact, unfortunately, we have been at the losing end. Apart from competitive intensity, which is something that we could have faced easily, we were stuck with our factories not being able to produce because it is in Sikkim. So, in fact, in the case of water heaters, we have significantly lost market share, and almost all the other players have gained. We are hoping that this year we can come back strongly. We have made a very good start. The first 4 months have been very, very encouraging for water heaters. So I think if all goes well, we should gain back the shares we lost last year.
Sure. And in case of wires, and if you could also help us with your market share in fans, water heaters, and wires, please.
So if you look at water heaters, it's around 2,000 crore category, and our market share is something like 14 to 16% in case of water heaters. In the case of wires, it's about 8%. In the case of fans, our market share is about 4%.
Sure. And if you could also help us the efforts that we are taking towards building our brand, what is the kind of budget we have for the current financial year and in the longer run towards brand building?
We have always spent 2.5 to 3% on A&P, and we'll continue to do that. Even in the first quarter, even with such adverse environment, we have spent about 2.5%. 2.5% of our sales. So 2.5 to 3% will be the budget. So last year we did 2,700 crores. So that translates into roughly about 80-90 crores of budget.
Sure. Yeah. Thank you so much for taking my question.
Thank you. The next question is from the line of Sharanjit Singh from DSP. Please go ahead.
Hello. Hi, Mr. This is Charanjit here. Hello.
Yes. Yes.
Yeah. So first is, because of COVID, what the new product introductions impacted severely, and how do we see in each of the product categories now the acceleration of these new product introductions going forward?
No, I think there has been a slight impact. You can say that there has been a 6 to 8 months delay in the launching a new model or new SKU. But it has not derailed our launch plans. For example, So our entire product launching pipeline is getting extended by maybe 4 to 6 months, because each lockdown is around 2 months, and then there are also suppliers which are affected, so maybe they are affected for an extended period of time. So with a lag of 6 months, we are able to launch whatever we wanted to launch for the year.
Okay, and these launches now incrementally, these are in which kind of price ranges? Because we have been trying to improve our gross margins through more and more upgrading the product portfolio, and so incremental launches, where do you expect to see?
Yeah, so if you look at the products that are growing fast for us are products like kitchen appliances, which has got a high gross margin. We have products like switches and switchgear also, which are growing very fast. All these products are having 30 to 40% gross margin, and in the case of switches and switchgear, they are already double-digit EBITDA products. So as these products become larger and they grow faster than the company average, there will be an automatic impact on gross and EBITDA margin for the company on a positive side.
Okay. So next question is on the channel front. If you can give us the current mix, and within that, the general trade, the e-commerce, what's the kind of mix right now, and how do we see that now, changing going forward, and to reach tier 2, tier 3 or the rural areas, are we pushing more in terms of e-commerce as a channel? Hello?
Hello?
Sorry, can you hear me?
Yeah, Mithun, we can hear you now. Yeah.
Ram, they want to be split between e-com, GT and MT.
Yeah, but broadly, I think, if you look at the electrical product, that is, if you exclude wire, switches, switchgear, and even pump, basically, I think that about 8 to 9% of our revenue in the remaining categories should come from e-commerce. Yeah. And I think e-commerce plus, organized retail, this should be in the region of around 17 to 18 odd %. Yeah. Which we are expecting to grow more strongly, as we invest more time, energy, and focus of our new product development on the emerging channels. Yeah. And, as far as GT is concerned, GT remains the primary, focus of our business, and, we derive about, 80 odd % of our business from GT. Some of it will be urban and some of it will be rural. We do not have a separate measurement for, what we sell out of rural, so, not able to give you an, accurate and exact picture as far as, the impact of rural is concerned. Yeah.
Okay. So thanks for that answer. If I can just squeeze in one more question, like you said that we had, kept inventory levels ready for the demand. So how are the inventory levels across different products right now, and how do you see the, restocking, levels by the dealers going forward?
Ram, you want to take this? Inventory?
Yeah, Mithun. I'll do that. Yeah. So I think, as Mithun had said, we had taken a very conscious decision to upstock inventory, mainly to be able to participate in the summer season, because we expected a good summer, given that the previous summer was difficult. But I think, we got into COVID and, could convert that into sale only in the months of June and July. I think fair to say that, the inventory has significantly come down at the end of July. And we expect the inventory to normalize by end of August. And as far as, what I would say, there would be a little bit of overhang of inventory, which is negligible though, but on the overall portfolio in the summer categories, because categories like inverters, air conditioners, or categories like inverter batteries. Yeah, these two categories, I think you can expect that beyond June, the recovery starts to be slow. So I think by and large, I think inventory will get normalized by end of August. I think barring these two categories, there we may carry some additional inventory. Yeah. As far as trade inventory is concerned, trade inventory is quite normal. I haven't yet seen the read for July, But I think the read at the end of June was that the trade inventory for at least V-Guard was more or less normalized.
Okay. So thanks for taking the questions. That's all from us.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is regarding the EBIT margins of our consumer durable segment. This quarter, we saw quite a subdued margin. How should we look at the margins going forward with the demand resumption?
So consumer durable also has products like air coolers. It also has new, launches in kitchen, where we are launching them, online and using digital media to promote them. So I think consumer durable margins will remain low because we are still in investment phase. To put it in perspective, we have spent almost 5 crores, on air cooler, campaign, where the annual sale is only 30 crores. So that is the kind of investment that is going into that category. So you will see that the consumer durable, margins are, remaining low mainly because of sustained investment in A&P. And once these categories start to mature, we should see, 11-12%, EBIT margins for consumer durable. But we are at least 3 to 4 years away. So yeah, in this particular bucket of products like electric water heaters, solar water heaters, etc., are extremely profitable. Even simple phase pump is profitable. But the new categories like kitchen appliances, breakfast appliances, water purifiers, and air coolers, they will continue to attract significant investment. So that is the reason why the PB margins are looking a bit low, because this year we had spent quite a lot of money on promoting air coolers for the summer season. But unfortunately, the second wave was much worse than what anyone expected, and we were not able to catch into the demand.
Got it. So my second question is about non-South. Now we continue to see good traction in non-South across consistently for the past few quarters now. So sir, anything you would like to highlight in terms of the gross margins of South versus non-South right now, and how should we look at the traction from here on?
So Ratan, you want to take this?
At a gross margin level, there is the two have more much now. There's hardly any difference between non-South and South. From here, as non-South grows faster, we should start seeing the operational leverage coming in.
Got it, sir. So, and just the last question on the price hikes. You mentioned 6 to 11% price hikes were taken ex-wires. Just wanted to confirm, this quantum was taken YTD or in Q1?
No, it's over a period. From starting maybe 7-8 months now. Last 3 quarters pricing actions have been taken. That's
got it. So what could be the price hike quantum in Q1 specifically from April?
I mean, these things have come in phases, so approximately I want to say 1/3 of that.
Got it, sir. That's it from my side. Thank you.
Yeah.
Thank you. The next question is from the line of Kondendya Mingammagadda from JM Financial. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have a couple of questions. So, firstly, just trying to understand what is the thought process on having a separate subsidiary for consumer durables, if you can elaborate on that.
Yeah, so Ratan, you want to take this?
Yeah. Okay, so the subsidiary will undertake manufacturing activity. Basically, what is imported or sourced from OEMs will now be made by the manufacturing subsidiary. And one of the benefits is also that new manufacturing entities have a lower rate of tax. So that's the logic.
Yeah, sir, I think in one of the previous questions, I think you mentioned about manufacturing fans and other appliances as well. I think for fans, we already have a factory, right, at Roorkee. and also for some other appliances. So what are the categories that you're looking at manufacturing the new subsidiary?
Okay, now so let me clarify on fans specifically. What we currently do is ceiling fans, where we already have a unit. PPW fans are imported. That's what will go into the new manufacturing unit in the subsidiary.
And what are the other categories, sir, that the subsidiary may enter into manufacturing for?
Inverters, batteries, stabilizers, kitchen.
Understood, sir. Got it. Sir, my second question is from your annual report. If I look at the contingent liabilities, it has been they tad higher for the past couple of years. So can you help us understand these litigations and also the bank guarantee amount which is sitting in our contingent liabilities?
The contingent liability, the main item is there is an ongoing income tax matter pertaining to TDS or certain TDS things. This is built over the years, but for one of the years, I think FY2011, the ruling has come in our favor, but the department has gone on appeal. Meanwhile, other assessments are getting completed and the same issue is being raised. Okay, but we believe we have a strong case on that, so we're not really too worried about it.
And what about the bank guarantees, sir? The bank guarantees
are given for bank guarantees are given in the normal course of business. It's like for purchases and corporate purchases, things like that. Yeah.
And they tend to remain high in general.
Yeah, it's in line with the volume of business. So there will always be a certain volume of bank guarantees which are outstanding.
Understood, sir. Thank you very much.
Yeah.
Thank you. Reminder to the participants, you may press star and 1 to ask a question now. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. Most questions got answered, just a couple of things. So on the durable side, broadly, overall gross margin for the company actually held up, right? In fact, actually they're up QOQ as well, quarter by quarter. So, the EBIT level performance is broadly explained by what just Mithun explained, that since the expenditure is quite high and the products are immature and new, and hence it'll take a while to basically come to double digits. Is that correct?
I was talking only about the consumer durable part, where where we are having new categories like air coolers, breakfast appliances and water purifiers, which are either being promoted through mass media or digitally. So the spends remain high for those new categories. The established categories within consumer durables are profitable and are and something like fans, they're consistently improving their gross margins as well.
Mithun, if I may just add to clarify, I think there are two observations. I think both which is one is valid for both consumer durable and overall. I mean, both are valid for both the cases. Firstly, see what's happening is that the EBIT margins are a function of revenue as well as the gross margin. So if if the revenue is down, right, the EBIT margin tends to go down. So that's, I think, one of the drivers of variables. But generally, our gross margins are more or less better. At similar level as this last quarter. So if you look at quarter on quarter, our gross margins are there. The one other cause of variation on gross margin, which is or on EBIT, it's actually on gross margin and EBIT both, is that this year our summer categories have underperformed as a proportion of the overall mix, mainly stabilizers. So that is also having some impact because stabilizer has a higher margin than the company average. So these are two factors which are impacting. But broadly, the variance in EBIT margin can be explained by revenue side variance than the gross margin variance in itself. Although there may be small variances in gross margin product to product, and which may be addressed through pricing corrections, some which have been taken, some which will follow. Yeah.
Got it, sir. So second question was on V-Guard consumer products. So Sudarshan mentioned 70 to 80 crores of capex. That's a normal capex for the company anyway, right? The another 100 crores announced, is it incremental to that or is it going to be incorporated in the same number?
I think it's...
the project I mentioned, those projects I mentioned will entail a total capex of about 200 crores. So that will happen over 2-3 years.
Yeah, so whatever the 100 crore of investment in subsidiaries, including the normal capex, correct. See, wherever it is a new factory, a new product line that we are building, it will come into the subsidiary. Wherever we are undertaking capex for an existing plant, will not come into subsidiary. That's all.
Just one more point to add, right? So basically, what Sudarshan is saying is that the overall capex will be expended over 3 years. Whereas, the 100 crore that he's talking about is, that when you set up, you are allocating some money towards capital, and that's what he's talking about. The initial projects may have a capex requirement which is commensurate with that. But the outgo of that will happen, gradually, right? Because, plants will take some time to set up and it will cross calendar years.
I understand. So it's not an incremental spend. Basically, whatever we are spending 70-80 crores a year over 3 years, that basically moves into the subsidiary. That's it, right?
I think I understand your question. Even before the subsidiary, we were talking about 70-80 crores of annual capex for Vega.
Yeah.
If the subsidiary were not there, we would have set up the plant ourselves under Vega.
Correct. Got it. And lastly, on the Sikkim situation, how is the situation right now, sir? Is the production on track now? Because we are hearing that still the 7 states in Northeast are still struggling with COVID. So what's your take on that?
Ram?
Yeah. So basically, the plants have opened again, and so the factory is operational again. Yeah, I think yes, the COVID impact is there in Northeast, and yes, from time to time, that has potential to interrupt our operations. I think, but for now we are good, and it's been a week since the operations have started again.
Got it. Thank you so much. All the best. Thank you for answering.
Thank you. The next question is from the line of Nawal from MK Global. Please go ahead.
Yeah, thank you for the opportunity. I have 2 questions. First, some details on the digitalization plan, what you had outlined in your annual report with 4 pillars, focusing around 4 pillars. What are the timelines you are expecting, it will be fully implemented? And second, as you are increasing your in-house manufacturing, will your R&D spends inch up, which has been in the range of 0.5% of sales from last 4 to 5 years?
Ram, you want to take this?
Yeah. So actually, the company has been working with an objective of digitalizing for quite some time, right? And this is a journey which is at least now 6 to 7 years old. Progressively, we have been intertwining, objecting towards, setting up the digital roadmap together with our functional transformation. So as and when each functional transformation is happening, we are also situating, digital infrastructure and digital capability into each of the functions. I think what the annual report is talking about is more centered around, some areas that we are currently working on. Yeah. So this has been a much longer journey for the company, in terms of walking towards enterprise digitization. Yeah, I think right now, we are working on digital supply chain and digital product lifecycle management. Right? These are 2 areas that we are working on. We have rolled out, digital capability towards what I would say as the retail management area. I think some of those areas are touched in our annual report. Yeah. So just wanted to say that, the scope of what we are doing in that area is much broader, wider, and we've been working for a much longer period of time in this area. But this is going to be a journey. I think, it's something that, because, this entire space is continuously evolving. Mainly, what we have tried to do is we have tried to make sure that we have platforms, which have potential, so that the challenge to evolve our digital infrastructure is not significant. So I think that's just to give you a background in this area, but I think we have a lot more work to do in this space. Yeah. Coming to your, I think there was another question which was, sorry.
On R&D spend.
The R&D, yeah, R&D spends, yeah. I think, no, as far as R&D spends are concerned, I think, there are two major initiatives which are likely in the next, 3 to 4 years. One is, I think, V-Guard has already announced that, we have acquired a piece of land in Kochi, where we are going to set up, what I would say, a greenfield R&D capability. This is going to come up in the next 2 to 4 years, and, it's going to support our, what I would say, the R&D infrastructure development part of it, yeah. The R&D process part of it, we have been, rolling out product lifecycle management capability over the last 2 years, and this may go on for another couple of years. So process side, I think, we will be, hardwiring the R&D, ability to enable speed and time to market, through this intervention, right, which will strengthen the ability of the R&D function to co-work with other functions and other stakeholders outside of the company also, other functions in the company and stakeholders outside. There is then the third piece, which is about, the ideation piece, and, which is basically, how do we get more, and, how do we, that is for creating impact. This is an ongoing activity, which is gaining steam, and, we're doing more and more work on generating, on inciting side, so that we are able to, create consumer relevant, propositions around which we can build our products here. I think today, where V-Guard stands, I think we are pretty much, we have evolved over the last 6 or 7 years or 8 years. And now we pretty much have, our own R&D capability, and we own designs, across our entire, across all the categories that we are playing in. Yeah. So as far as the scope of investment in R&D itself is concerned, which is in tooling and molding, which is fundamentally a subset of the capital expenditure which has already been shared by Sudarshan. That will be more market based, and the category need based, and I think that's something that is something we are not constraining at this stage, and it still remains a less significant part of our overall capex, because most of our categories, right, the investment in tooling and molding is not very, it's not a high ticket item, barring probably a air cooler or a switches, right, where, the tooling investment may be very, very significant, right. So that's to give some perspective to you in this area. Yeah?
Okay, and one follow-up on digitalization. So if one has to look at, as you're saying, this is like a 6-7-year-old journey when you started, and much of that has been already in the system. So if one has to rate from, between 1 to 10, where are we? The intention to ask is basically whether the majority of, efficiencies are already in your financial performance system processes, or the majority of that is yet to be seen in years to come.
So I think let me put it like this, right? So data analytics based benefits are yet to come in. I think as far as the process standardization and the choice of comes, I think for digitizing, these are already in place, and the workflows are already on our digital platform. I think function to function, this is grateful. I would say it's you should look at this as a journey. Yeah. So it might take, for example, you would take a function, it would take you a year, to design and hypothesize. It would take you another year and a half to deploy. Yeah. And then, it will take you another year and a half to extract, benefit out of the process, right? So it has to be seen as a journey. And this journey is in different stages. If you look at a function like we started with first, they have made a phenomenal, journey. And, this is like, fully mature, and, we have been able to get whatever benefits we wanted some 3-4 years back, right? And from there on, progressively, different functions are at different stages in the journey, and I think, benefits in many other functions are work in progress or can be expected in coming period.
Understood. Thank you and all the best.
Yeah, thank you.
Thank you. A reminder to the participants, please press star and 1 to ask a question. The next question is from the line of Achal from JM Financial. Please go ahead.
Yeah, thank you for the follow-up opportunity, sir. And sorry if I'm repeating the same question. So in earlier answer, you mentioned that, the gross margin at 33% was despite a lower mix from our high margin product like stabilizers. So, how do we look at this? Is it driven by, some element of an inventory gain in the sense the price increase kind of had a benefit of that and to do with the premiumization?
No, I think, see, what is happening is summer products have products like stabilizers which are high margin, but summer also has lower margin products like inverter batteries. So I think, blended basis, they will still, come to what the company average gross margin is.
Okay. So, given, if you're looking at for the rest of the year, I just wanted to see that clarification. I think Mr. Kasturi said 12.5% something. So is that the margin we are talking about for rest of the year?
Let me put it this way, FY20, that is 2 years back, our gross margin was about 29%. Last year the gross margin had crashed to 24.5% because the volumes were very low. This year it's come back to 27.2%. So we are still around 1.5% lower than our FY20 gross margin. That is what, Ram had mentioned that, that is probably because the stabilizer contribution was extremely low. I think we have lost close to 60 to 70 crores of sales just in air conditioner stabilizers alone in Q1. So that's the kind of, fall that has come when we compare to 2 years back.
Okay. So in terms of the EBITDA margin, one would be looking at least a double-digit margin, if as in at least a 10.5%, or like earlier you had talked about 100 bits improvement year after year. So how do we look at that?
Yeah, I think if we had hit 850 crores of revenues, which was our initial plan, we should have hit 10.5% EBITDA margin.
Sorry, what kind of revenue you said? I couldn't hear that clearly.
About 850 crores of revenue is what we had anticipated to do in Q1, and we are almost 300 crores short of that.
Okay, understood.
So I think just to add, right, I think the point we are trying to make is that, by and large our gross margins are maintained, right? But, it looks like the EBITDA margins are lower. That's because the volumes have not materialized, right? So if planned volumes come through, we will hit the planned EBITDA. That's the first point. Second point is that, within the planned business, there is a contribution from stabilizer. So if you see the actual business which has happened in the summer quarter, the sales of stabilizer have been not in the same proportion even in the lower volume. And that has had a 1% impact on the overall gross margin for the quarter, and which will be reflected in the EBITDA also. So that's the limited point that I think we were making.
Understood. This is very helpful, sir. Thank you so much.
Thank you. The next question is from the line of Hitesh Tang from ICICI Direct. Please go ahead.
Thanks for the opportunity, sir. Just wanted to know this quarter, the tax rate was on a higher side. This is because of, no benefit from the Sikkim plant or lower benefit of Sikkim plant. Is it that?
Yes, it is. There is a lower proportion of profit from Sikkim, which leads to a higher tax rate for the quarter.
So what one could, build in for FY22 or 23, sir? What kind of tax rate?
The full year tax rate will be around 25%.
Okay. Okay. And sir, my last question pertains to our, strategic investment in Gigadyne. Have you launched any product or from that technology, or are we planning to launch using that technology? Which products are we going to launch? Where are we focusing? If you could share some thought on that also. Thank you.
Yeah, Ram, you want to take this?
Yeah. So, Gigadyne is a deep technology startup. Okay. So the cycle time for technology developers will be long. So you're not going to get an immediate outcome like next quarter or the following quarter. I think, we are at least a few years away before we, get up, what I would say, commercially marketable product. Yeah, that's the first point I want to make. So there is no immediate implication of that for this financial year or next financial year. Yeah, first point. Second point is, fundamentally, this plant is making energy storage, they are basically bringing energy storage technology. And mainly that will impact our inverter battery business.
Okay. Okay. Thank you, sir. Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Aditya Bharti, closing comments.
Thank you everyone for participating. On behalf of Investec India, I would like to thank the management team for giving us the opportunity to host the call. Sir, would you like to make any closing comments?
Thank you, Investec India, for hosting this call, and please stay safe, everyone. Thank you very much.
Yeah. Okay, thank you.
Please subscribe and press the bell icon to never miss another update. Please like,